We're here at the Nasdaq in the epicenter of Times Square. Happy to be here to discuss the future of IPOs, what we've seen this year, what we're going to see going forward. I'm with Raman Chitkara, the global tech leader at PwC, Nelson Griggs, the head of global listings at Nasdaq, Rick Heitzman, the founder and managing director at the venture capital firm FirstMark Capital. Thank you all so much for being here. It's been quite a year for IPOs. We were off to an incredibly slow start despite we had some bumpiness in the stock market at the beginning of the year. We're finally seeing a pickup in September and October. Could we just start off? I mean, what does the beginning of this year and what we've seen so far tell us about the overall market for tech IPOs and IPOs overall?
Well, if you look at it, we had a very strong IPO market in past 2 years, 2014 and 2015, both in the US and globally for tech and otherwise in general. So it is not unusual once you have 2 strong years that the next year is going to have a little bit of cyclicality and you're going to start slow. And we clearly started very slow this year, very high level of volatility, whether it was concerns about oil prices, global economy, job creation, China slowing down, and that really set a very bad stage in terms of how we started. There were no US IPOs in the month of January. But when you look back, yes, we are down year over year because of a very poor start in Q1, but things seems to be picking up. And when you look at the results for Q3, whether it's the total IPOs in the US or total technology IPOs globally, numbers are not that bad. Now, when you look at US, like you had IPOs numbering in the neighborhood of about 40. Globally in the technology, there were about 20 IPOs. Those numbers are not bad when you compare them to last year. Last year, there were 45 IPOs in the US, so 40 versus 45 is not that much bad, only 10% decline. While year to date, you have 45% decline. And similarly, in the global technology IPO, you had 20 in Q3. Actually, that's much better than last year. There were only 11 in Q3 last year.
And that was around when we started to see this dip happen.
Absolutely, absolutely. So when I reflect upon it, yes, we've had a challenging year, but nothing out of ordinary. My view, I've been following IPOs for over 20 years now, and you go through these cycles where you have 2 strong years, and after that you will expect a slightly soft year.
So Nelson,
the only thing I'd add to that is you highlighted that I think a lot of the challenges going into 2016, but the backdrop of the deals that went out in 2014 and 15, about 80% ended up the year below their offering price. So you had, not only was it a challenging, I think, some headwinds in the overall macro markets, the deal performance was not that great from 14, 15. So a little bit to start the year, it was a little more of a demand problem on the buy side. They weren't as excited to go into IPOs, especially with the volatility in the marketplace. But that changed around April, May. We saw the market kind of change a bit, where there was a little bit more on the buy side demand. We had one deal go out, particularly Talon, and that started my phone ringing, where more deals and it started lining up. So I think you have, as you mentioned, the market's really rebounded. It's strong right now, and we'll have some some headwinds going, or some tailwinds going in 2017.
So I want to get back to that, but Rick, tell us what you've seen as well.
Now, we view it as the market being very fickle. So I think even data points which don't affect kind of the fundamental growth, fundamentally different innovative companies that go public affect the IPO market. So the global oil price or slowing of China affects a biotech company or an early stage technology company that's waiting to go public. And it just means that, hey, the markets are fickle. Investors on the whole might be a little bit risk averse. But we continue to see those companies grow, and whether those companies, from my perspective as a long-term investor, go public this year or they go public next year, or Q1 versus Q4, it doesn't really seem to be an issue. As a long-term investor, I always wonder about the short-term fickleness of public market investors, and that all kind of comes out over time.
So speaking of fickleness, as you said, Nelson, last year, I mean, we saw really tough performance from a lot of the IPOs that went out. They fell below their IPO price quickly. This year, from what we've seen, especially with the tech IPOs, is the polar opposite. I mean, we've seen them surge. Their first day pops are really historic. And it's been kind of across the board. It seems like the buy side demand has really changed, and they're clamoring,
I
is
think
what I
you look
hear.
at public companies today are really challenged for growth. The large cap companies, that's why you also see a lot of M&A activity happening, especially in the tech sector. Traditionally, you saw tech being on M&A being bought by other tech companies, and now you see really non-traditional companies also moving into M&A and tech. So you have this M&A backdrop. Public companies aren't growing that strongly, so you have these growth IPOs that are going out right now are doing exceptionally well. So the buy side is really growth. They're starving for growth, and that's why we've seen the deals, I think, do so well.
And as I talk to public market investors, there's always, the fickleness always comes into play. They say, well, these companies aren't profitable, looking at all the negatives. And then a month later, they say, well, how come there's no tech IPOs? I need to buy growth. I need to buy growth. And therefore, the few IPOs that get out, or maybe they look backwards a year and say, what's gone out in the last year, and have those companies pop. So the fickleness and the short-term nature of it doesn't affect companies in our portfolio. It takes them about a year to begin the process, get ready, get in compliant, get all set to go, and eventually go public. So it's not a spigot that turns on a day-to-day or a week-to-week basis. So that creates some of the kind of price bouncing around in the public markets. But I also think that the other liquidity has driven up demand, as you see the number of M&A deals driven by overall low interest rates.
See, aftermarket performance of IPO stocks is very important. It reflects on the quality of the IPOs, but it also boosts the confidence of the investors for future IPOs. And so one interesting data point I saw was that in the month of September, there were 18 IPOs in the US, and 17 of them were trading above IPO price at the end of the quarter. That speaks well for the IPO market going into Q4, and certainly Q4 has started at a reasonable note. So it sometimes feeds on itself, and also you have the, to some extent, resetting of valuations and expectations. Sometimes in the bull markets, the valuations go too high, and as a result, the aftermarket is not that strong, then that weakens the confidence. Then you come to a slower market as we had this year, wherein, like once the bottom is reached, and then you start seeing that the aftermarket is doing better, and that boosts investor confidence, and they come back and buy more. They're willing to take more risk and buy more stocks, IPOs.
So I'd like to, speaking of that, I'd like to get to what you see coming in 2017. And I mean, in the next few weeks, we have an election, historic election coming up. December is notoriously slow for IPOs, right after around the holidays. When and will we get back to normal, and what is normal for an IPO market, both in terms of the number of IPOs and the performance? This is, as you said, we're seeing everything jump in price so much. Last year we had such a rough year for IPOs, the performance. So what does next year look like?
I think there's going to be continued volatility in that I think a lot of companies are waiting until post-election to go out. So I think you're going to see a strong end of November and even December into the holidays, which you wouldn't see in a non-election year or a year where IPOs weren't strong. But I think in 17, what you're going to see is a lot of the mega IPOs that people have been waiting for, the Ubers of the world, are going to get out. And
you're predicting in 2017.
I would say a lot of we're investors in some of them, so we can't talk about all of them, but the Ubers of the world and the companies that you've been hearing about in the private markets, they're household names from a consumer perspective as well as from a technology perspective, will start to get out. I think that will inform a lot of what the real market is, because it goes back to investor sentiment and market demand for new offerings. And IPOs like Uber are going to be massive.
So Rick, why next year? I mean, we've heard Uber's CEO say many times Travis wants to wait as long as he possibly can to go out. And some people were telling me earlier this year, maybe they've tapped all the pools of private capital they possibly can. Then we saw that huge investment from the Saudi Arabian Sovereign Wealth Fund. What is going to make that Uber, and not just Uber, some of the other big unicorns, whatever we want to call them, what's going to make them tap the markets next year, the public markets?
Well, I think that there's a bunch of reasons to wait, and I know, just to use Uber as a microcosm of it, they have some smaller competitors, whether it be on a business line basis or a geographic basis, that they're still trying to make sure that they understand all the bells and whistles and all the levers they have in their business. But I think you get to a point where you can only wait so long. They tapped the kind of later stage private markets 2 years ago, 3 years ago, even more recently. And at some point, those investors are going to want liquidity. And at some point, there's only so much fine tuning you can do before you have to hit the public markets. So you have to grow up and get out of your parents' house at some point.
I certainly wouldn't comment on a company right now, but I think you look at the heavy private rounds were 2013 and 15, so you look at the broader unicorn set. Depending if that private capital comes back again, this was a very slow year for private capital. So I think if you look at these companies needing to either go public, have an M&A outcome, or raise more private capital, after you go through that cycle of 13 to 15, they're at that point now where they're going to need to continue to grow their businesses, or need more capital. So again, whether that's public or private or M&A, I think you have 140 some odd unicorns. We usually get 35 or so tech IPOs a year. Something's going to happen.
But do you see that the private capital market isn't there? I mean, is it?
Well,
are we at a point where we can call what's happening next? The valuations, I think, tilted much towards the buy side the first part of this year, where sellers had a harder time getting the valuations that they wanted. We do have what's called Nasdaq private market that works with companies on secondary liquidity, and we do see it tilting back a bit to the sell side in terms of valuations. But this was definitely a slower year than 2013, 14, and 15 for companies, or the ease at which private companies could raise additional rounds. Which I don't know.
No, so we've seen the valuations dip in the first half of the year, renormalize in the back half of the year. But the issue is going to switch in 17 to liquidity. So as much as you can raise capital, especially capital from non-traditional private sources, you talk about sovereign funds, you talk about traditional public market investors that have basically invested in illiquid assets in 13, 14, 15. They're ready to have some liquidity. And I think the lack of liquidity is what's going to push some of these guys out and might prevent those non-traditional asset managers from investing more.
There are two other factors coming into play when it comes to unicorns. What you had was a lot of unicorns minted in 14 and 15 at a lot of high valuations. So they were valuation rich, a lot of money was raised. What you have seen in 16 is a little bit of resetting of and rebalancing, resetting of expectations as to what these companies can do, and resetting of valuations. And at the same time, they're also continuing to make progress in terms of executing the plans. So you see a kind of convergence taking place in terms of resetting at one side and execution on the other side, which should hopefully lead to more IPOs in 2017 and beyond than what we have seen in 16. Interestingly, when you look at the historical IPOs and post-market performance of unicorns, and it has not been that great. Rather, from 2014 through 2016 so far, there have been about 19 unicorns which went public, and over half of them were trading below IPO price.
Wow.
So, but that just reflects the valuation challenges. I don't believe in there that reflects whether or not these companies will be ultimately successful and ultimately be very profitable. But the valuation challenges are truly real.
So can you speak to the mindset of entrepreneurs and corporate boards right now to tap the public markets? I mean, not only did we see a real slowdown this year until recently, but we also saw a number of companies that I had heard were just about to go out, and at the last minute they sold. So with the rise of the private markets, we've seen a lot of factors keeping companies away from the public markets so far, at least until recently. What are entrepreneurs thinking? What's the mood in Silicon Valley? Is this a prize that people want still to go out and ring the bell and be public, or is there still this real wariness of going out?
I hope so. I hope they want to ring our bell. You speak more than mine.
Sure.
But I'll tell you about my thoughts.
I think there's been probably a 10-year cycle of coming out of kind of the early part of the century where Sarbanes-Oxley was put in place. It became very uncool and very difficult to be a public company. So that swung back that we're going to stay private longer. And Mark Zuckerberg was really kind of the figurehead for that era. We're going to stay private later. We're going to raise private funds. We're going to not go public till we're damn ready. And that was his opinion of the whole thing. but you've seen the transformation from the hoodie-wearing Mark Zuckerberg to the suit-wearing Mark Zuckerberg. And as he started to talk about being public, it's a maturation process, and it's part of growing up. It's part of growing up as a company, as an executive team, to be able to take that next step, access the public markets for that capital, transform your investor base. You have early investors who get liquidity. You have employees who you really care about getting some liquidity, and then you're able to then grow to the next level. And I think it's gone from maybe 20 years ago, everybody wants to ring the bell and, and show pictures to their friends, to, hey, we don't want to ring the bell, this is a big pain in the ass, to now, hey, we do want to ring the bell, and this is part of a company maturation phase and even a CEO founder's maturation page, and where they want to take their company in the long run. So we see the pendulum swinging back to this being a real milestone for most great companies.
Are you both seeing that as well?
I would tend to agree. I think that the Jobs Act in between that did also throw a little bit of a curveball into the marketplace, where the shareholder count used to, once you tipped 500 shareholders, you had to go public, and that was what happened to some larger companies. Then that did change to 2,000 shareholders, not including employees. So companies did say for a year or two there that, hey, there's an opportunity to stay private longer, pivot the business model, make all these changes. But now we do see companies, a lot of them really wanting to go public, preparing to go public. And I think that idea that there are windows to go is very, very relevant, because when a window does open up, companies now want to be prepared. So as I mentioned, when the market did open up in April, May, the phone started ringing. We started getting calls saying, hey, we're ready to go. Help us get ready to go. So that does, I think that mindset of I want to go public is still there with the overwhelming majority of companies. There are some of the largest of the large that do have a little more flexibility and may stay private a little longer than you expect. But that's just, I think, their flexibility that they have with their model.
And just from your phone line, Nelson, ringing, I mean, what does it look like going into the first half of next year?
The election's a bummer right now, because quite frankly, we have some momentum. The market is strong. We do have a fairly decent-sized technology Chinese deal this year. Then we have a break with the election for almost 2 weeks and Thanksgiving. So you kind of take out most of November, unfortunately, other than the last week of November, then 2 weeks in December. We think we'll have another 4 technology deals on Nasdaq throughout this year.
4, you said?
That'd be my guess right now.
Okay.
Which that's a pretty strong year for that holiday time.
It's a pretty strong year. So Nasdaq alone would have 18 technology deals, be about 20 in the U.S. So we felt pretty good about it. Not our capture rate at Nasdaq, but just in general, that's a decent number compared to the percent of overall IPOs. So IPO market, let's say we end up with 100. Having 20 or so % technology is right on. But the overall numbers we'd like to see normally at Nasdaq are about 150. So again, if you look at it on a percentage basis, I think the number of technology deals getting out relative to the rest of the sectors is right on.
Which it was not earlier this year.
Which it wasn't earlier. So we had a real good, real good momentum right now. And then again, you look at, I completely agree here that we'll see some more deals in 17 will be a very active year for us.
So one point I'd like to make is that fundamentally, the concept of startups where you have equity participation by employees hasn't changed and is not going to change. And the only way when employees are participating in equity, they are going to get liquidity is just the way the VCs are going to get liquidity through a buyout or through an IPO. In my view, yes, there may be personal biases, but at the end of the day, employees and the investors are looking for the highest possible valuation. And if the highest possible valuation is in the IPO market, that's what they're going to leave. Invariably, you also have disruptions in the marketplace, so the M&A comes into play. So well-established players are going to use their market cap or their wealth in terms of cash balances to go and do the acquisitions. And more the disruption, more the desire to go and get somebody, so the willingness to pay at a higher price. So those disruptions come into play and disrupt the IPO market because the M&A guys are willing to pay a higher price.
Which we've seen a lot
So
this
it is
year.
not entirely their discretion as to whether I should go IPO, whether I should go M&A. I think it's the M&A market which kind of disrupts the IPO market, and M&A market feeds on IPO market also. So there is no perfect science that they don't want IPO or they want IPOs. Ultimately, they want high valuation, whichever gives them high valuation.
Only minor point I have to bring in there, because I run the market, is there is the ability now for employees to have liquidity pre-IPO. We have a product that you only go in the front door, so we work with clients directly, but there are a lot of companies this year we work with, about 25 or so. The numbers are down. Last year was closer to 40, but the deal sizes are pretty large, where the companies are providing a portion of liquidity back to early investors and employees. So, but it's a I think liquidity is out of the bag. That is how employees are being compensated. That's how they need to recognize value. So whether it's pre-IPO or post-IPO, you're absolutely right. That is the driver.
But just in fairness, one thing I've heard is that there's been a lot more receptivity to giving employees liquidity, as you said, but it's different, right? Structurally, for the most part. I mean, you don't vest necessarily in the same way. You don't have as much the same
usually
optionality.
There are set rules. I know a couple of our companies have worked with Nasdaq to go in through the front door, set rules. So there was a period when the IPO pipeline stretched out, and there was a number of companies, Twitter being the obvious one, where there was no rules, and that therefore kind of played with the cap table, and people did a lot of price discovery and things that were disruptive to the cap table. But we've now moved to a system where there's rules in place. You're able to sell a certain portion of your vested shares. Those shares, you're able to get liquidity in a certain time horizon, and it relieves a little bit of the pressure that employees have. So that not only do they want the highest valuation, but they probably want some liquidity over time. And as companies have taken longer to go public, this is a way to relieve some pressure on some founders, key employees, and even angels in some deals.
So it's fair to say it's done similarly to once you are public? Some of these
structurally, it's somewhere in between, but substantially similar. And I think the most important thing is Nasdaq runs kind of a rules-based process to getting that done to make sure things are done in a balanced and fair way.
Yeah, it's a company control process, so they are setting the price, and it's up to the employee if they want to take advantage of that or not. But you see, again, as I mentioned, it's not they're selling all their shares. They're at the point where they want to recognize some liquidity to show the value that they've achieved over that period of time.
So we're a week away from presidential election. So let's start. If we have a President Trump next week, what does that mean for the IPO market?
I have no idea.
I'll jump in. Might as well. I think that it stops it for the rest of the year. I think no one anticipates a President Trump at this point, nor do people know what a President Trump would do, even on a day-to-day basis. So the market likes rules. They like stability. Market hates risk. Right, so if you have somebody in charge you didn't expect to be in charge, and you don't know what they're going to do, you're going to say, I'm not doing anything. I'm not buying anything. I think people would move to cash. They might move out of growth and speculation and move back to real assets. So I think in that world, the chance that people go out on the risk curve and take it and buy a new company is very low. I think even our companies who are getting ready to go public say, all right, well, let's take a pause and see what this means not only to the financial markets, but to the economy as a whole. And so I think it puts a big pause on the markets for at least the balance of the year.
Historically, I think whenever the markets get shocked, you certainly have a pause. But more often than not, markets readjust. We've seen this with Brexit. Yes, there was a shock, and then after that, readjustment. How long the period of readjustment is, yet to be seen. But I would think historically, I haven't seen any events over the years and decades which have caused long-term stalemate, like in capital markets.
But do you agree that at least for the balance of the year, it would be unlikely to see IPOs?
I think if the market is shocked, right, which many people believe that would be the case. If the market is shocked, yes. Investors don't like surprises. They don't like uncertainty. So if the market believes there is uncertainty created as a result of the election outcome, you can expect a pause.
Yeah, I think that point made is the right one on both cases. It's the uncertainty. If there is uncertainty, the market hates that. That's why when you see what's called the VIX be above 20 or so, it's very hard to get an IPO out because it means volatility is high. That said, the day after when the Brexit was announced, it was the market's off, shut down, and then really 4 days later, it was back to the same level. So I think it just depends on the enormity of the shock. Brexit, we thought was going to be a bigger shock. Trump would, I think, be a very big shock. That said, the market, rebounds quickly and moves along, then it's back to game on. So it's hard to predict how long they're going to last.
And so, President Clinton, your predictions are all the things you've said. If we see a President Clinton next week, this pickup, everything you're expecting.
I would assume that it's the opposite, right? It's business as usual. Mm-hmm. It's like, here's a candidate that we know we expect to win. Things are happening as expected. Therefore, I feel less risky, less uncertainty. And you have a sense of what those policies will be. There might be some market unfriendly policies, especially as it relates to capital gains, but at least there's some rules of the road which eliminates uncertainty and risk.
I think people then start looking at what sectors may be stronger based on some policies or the platform that was announced, and so that's where that game starts playing about what markets or what areas may do better than others, and I think we'll see that happening.
So before we wrap up, I'd like to take a poll. Let's say tech IPOs next year. Let's put a number on them.
Is there an over/under, or is there a number? Who's setting the line?
You want to start? You want to set the line?
Well, you're saying the normal year there's 150 IPOs and 30 are from tech. If it's 20%, I'm going to say 27.
Okay, Nelson.
32.
Okay.
So I generally track tech IPOs at a global level versus just at the US level. And at a global level, if you see, we had close to 100 IPOs, plus and minus 100 in the last 2 years. I think this year would be substantially less than that. So I would say globally next year I would expect to at least 75, 80 tech IPOs.
And then can you give us a US number?
Yeah. So in terms of the US piece, in terms of generally, is about 30%.
Okay.
So you could say 25 to 30.
All right. So interesting that everyone's roughly in the same ballpark.
In the same ballpark, normal year, maybe even a little bit better.
And Rick, your bet, it sounds like, is of those, we're going to see some big
mega
deals.
I would say from a number perspective, you're right around a normal pace. From a dollars raised, proceeds, valuation, it could be a historic year.
Do you both agree with that? Are you expecting some of the big ones to come out? Big deals?
Please.
Given the strong number of unicorns which were minted in 14 and 15, I think it is natural to expect that some of them will have an IPO next year.
Yeah, I think some will. I'm not quite as bullish, Rick, but I think there'll be certainly some deals. And 17, 18 are the years. And
just going into this year, I heard a lot of people telling me that they were expecting the unicorns to come out, at least some of them. But you think it's different next year?
Yeah, I think the unicorns weren't right. I think the private markets were so strong. There was a bias in 13 to 15 of why go public? I could do this faster, easier, at a better valuation in the private markets. And that was conventional wisdom 13 to 15. So people really, at least from my vantage point, didn't start preparing for a public financing until 16, knowing they might go public in 17 or 18. And so you're seeing some of those companies get their house in order for that type of event.
All right. Well, thank you all so much. I hope we talked beforehand, but late December next year, I'm going to see how everyone's predictions fare.
We'll see you here.
Right, yeah.
All right.
Thanks very much.
Thank you very much.
Thanks for
joining us today.
Thank you.